We're looking at the economic outlook for Nigeria in 2024. And like I said, there have been projections made for the Nigerian economy in this year. One of them is the GDP growth. It is expected or projected that Nigeria's economy will grow by 3.3% in this year. What's your take on that? Does it look feasible?
We cannot discuss the question of growth without looking at the trend. Generally, if you compare it to last year, it is expected that the growth will slow down a little because the government is trying to fight inflation. There's a global trend to slow down economies worldwide because of the heated economies, the Ukraine fight, the Israel-Gaza war, the aftermath of COVID-19. And so there's a general slowdown in prediction. The World Economic Outlook says that the world is going to slow down by an average of about 1 percentage growth point. So Nigeria growing for 2024 is not big news, especially when we consider the fact that it's expected that it is going to slow down compared to last year. So Nigeria will begin to recover around 2025, 2026. The international growth plan for the world is slowing down, and then the fastest growing economies in the world happen to be African economies at the moment. Emerging economies and developing economies like Nigeria. So while the developed world will grow at just about maybe 1 or 2%, Africa is still maintaining between 4 to 3% growth. So Nigeria happens to be in that trend of those countries that is predicted to grow slowly in 2024.
Talking about the Nigerian economy, I would like you to talk to us about some of the trends, some of the policies that might likely shape the economy in the year 2024. You have the CBN coming up with some of its initiatives talking about recapitalization, and then the Minister of Finance and the Coordinating Minister of the Economy also talking about the year 2024. In your view, what are some of the trends and policies that will shape the economy in the year 2024?
I think for Nigeria, what we are trying to do, what our major achievement for 2024 will be in the area of business confidence. The Banking Consolidation program is going to simply improve the confidence in the financial sector because bigger banks are expected to be more stable. The federal government, the budget of 28.7 trillion also communicates to the world that the government wants to the government is intending to spend heavily on the economy, and that means business confidence will be improved by that expenditure framework. And then we also expect that if government is using its monetary policy to tighten the economy to slow down inflation, when inflation is down, business confidence increases. And so this policy mixes is expected to create a general positive outlook for the economy for 2024. Okay, and then the government started very well too by signing the budget into law. For some time, between 2016 and 2018, we had a problem with our budgetary cycle. But between 2021 and 2022, we tried to get the January-December timeline. And then this is the first budget he's signing into law. And then it is a good precedent that the president signed it into law as the year is starting. So we have returned back to our January-December budget cycle, which is good. It makes the business world trust the government and see that the government is interested in ensuring that its budget is well financed and operated according to the Fiscal Responsibility Act and according to the laws. So if government is the monetary sector is consolidating, the fiscal sector is trying to operate by rules, the general investment climate gets a positive news, and it communicates that this year may be a good year for business. But the implementation will determine how much of that confidence is misplaced or actually in order.
Okay, looking at the budget, are there areas of concern for you? Are there sectors where you feel not much of activity or not much of change will happen in the year 2024?
The budget, there's nothing very novel about the budget, except that it is good news anytime we have a budget that has more capital expenditure than recurrent expenditure. It communicates that the government is interested in spending in the critical areas of the economy. The budget focus mainly is on security and on capital expenditure in terms of road construction, power, and other areas. So that's a good plus. The 35% of that budget goes to capital expenditure. 30% goes to recurrent expenditure, which has always been the burden of our budgets. And then 1/3 of that budget goes to debt servicing, which is looking at the debt financing. So before now, about 2 years ago, it was about 50-50. The half of our budget went into debt payments, but this time around, it is 1/3 of the budget. So we are reducing the size of our debt payments, increasing our capital expenditure, and balancing our recurrent expenditure. It is also instructive to note too that the budget doubles the amount of statutory transfers to the judiciary. What that does is that it puts more confidence on the business sector, because most of the business problems we have are litigation problems, which ultimately fall into the judiciary. So if the judiciary is going to be independent, ability to take decisions and make judgments that are not based on interference from the other arms of government, we expect that the judiciary should have financial independence. And this government has doubled that amount by over 100%, from about 161 billion to about 340 billion to the judiciary. This has a positive outlook for the judicial independence and the ability of the courts to make independent judgments and even facilitate business litigations. So these are the positive little innovations in the budget that may seem to make the budget pro-business, pro-output, and then pro-employment. And we also notice too that the budget tries to look at the federal government inviting foreigners to invest in this country. The economic fundamentals at the moment does not support business, because as we hear, about 7 or 8 major international brands are leaving Nigeria before March. Now, when government prepares a budget and is talking about budget transparency, talking about business confidence, talking about the ease of doing business, we may expect what that may do is that it may slow the capital flight out of Nigeria in the interim. It may also give those businesses that are planning to leave in the next 1 or 2 years to reevaluate their statistics and their figures and see whether they can stay. Because what we currently have is a migration of capital out of this country because of the gloomy outlook of the economy. But this budget is looking at trying to see if they can restore some basic confidence on the economy and store the outflow of capital funds out of this country, and maybe allow more inflows. Personally, I am not very optimistic about what is going to happen in the next 2-3 years in this country, because of the fact that the economy is still struggling. Inflation is still very high. Unemployment is still very high. Power sector, there's no much investment in that sector. In respect to power generation, we expect that we should be able to generate at least 20,000 megawatts by this time, but we are still struggling between 6,000 to 10,000 megawatts. So there's no, like I told you, there's no major innovation in the budget per se, except just minor palliative improvements in the budget, which may not be big enough to redirect the investment flow into this country. So let's see how it goes. I also strongly do not think we should throw away the federal government's positive outlook. We must also look at the fact that Nigeria is owing a lot, at least 70 to 80 trillion. And at the moment, Nigeria is not in a good revenue position. Although just recently it was announced that the non-oil revenue has been growing at least about 60 to 70% year on year. So we expect that in the next 2-3 years, our non-oil revenue will grow more, maybe to 200 to 300%. That is when we begin to have positives from the budget. At the moment, we're just trying to weather the storm and try to see whether we can balance things in the interim to forestall the failure of macroeconomic fundamentals of this country. So the budget is just simply a maintenance budget. It is not innovative. It's not going to create major swings in the economy. It's just going to ensure that there's some balance and there's some organization within the fiscal expenditure framework.
All right, let's look at the inflation rate. You know, one of the indices that will influence how the economy will turn out in 2024 is the inflation rate in Nigeria. According to the last figure released by the Nigeria Bureau of Statistics, the inflation rate is at 20.2%. Now in the year 2024, what should be the priorities of this government in order to be able to manage the high cost of living and then the high rate of inflation in the Nigerian economy?
Yes, inflation affects the real incomes of individuals, and that means if you earn 100,000 at the current inflation rate, your 100,000 is only worth about 40,000 of last year. What that does is that it's going to affect people's real incomes, and real incomes will translate into slowdown in aggregate demand for goods and services. A slowdown in aggregate demand for goods and services will lead to slowdown in business investment, and that is a vicious cycle. So inflation is not good. So what the government can do, like I said, is to tighten the economy from the financial angle, tighten the economy by reducing money supply, squeezing the economy such that we reduce the monetary aspects of that inflation, and then grow output. The government intends to spend to produce a lot of to fund a lot of agricultural programs. It is intended to boost the real sector, because from the supply side, what the government can do is to boost productivity from the real sector, ensure a lot of investments in agriculture to ensure that we have sufficient food, because food inflation is a very large component of total inflation. So if we're able to boost the supply of the goods from the real sector, such that we're able to allow that supply match up with the falling demand and get a certain basic equilibrium, then we expect that people will be able to at least buy goods at a cheaper price, given that their real incomes are falling. But then I have a problem. The government intends to also increase minimum wage. This is a counter policy. When you increase minimum wage in this period, are you not also going to increase the money supply? And if you increase minimum wage and you increase the money supply, is that not more problems for the CBN too? Now that their policy is to tighten the economy and to squeeze the economy such that the exchange rate is stable, the inflation rate is stable. So we need a measure of policy mix here, okay? And there are going to be some trade-offs. Which one would the government be trying to achieve in the short term? Is it growth in output, or is it growth in employment, or is it in between those two? If you increase output, then what that means is that people will be able to get goods at competitive prices, okay? But if you reduce the money supply, then people will not have enough money to buy out that increased output. So what that means is that the government is in a fix. So we need a combination of policies that are complementary. So we should not have a situation where we have contradictory policies. Why the central bank is trying to stabilize the naira value internationally, because if the exchange rate, for instance, is very high, most of our factories depend on imported inputs. So what happens is that we are going to have a cost push element to that inflation, because we import over 65% of the inputs we use in production comes from the external economy. So if the exchange rate is still very high, then we are going to import this inflation to this country in the form of rising exchange rates. Now, that's a problem that the CBN has to tackle. Slow down the exchange rate differences, reduce the exchange rate, and then tighten the monetary system to ensure that prices and exchange rates are low. But from the real sector, the government should be trying to expand output, productivity, not income. Because what should generate more money for Nigerians is not just the fact that you increase their wages. The wages increase must be matched by productivity. So how much of output is the government investing in this period? What is happening to agricultural output? What is happening to power output? What is happening to the general output of the real sector, tourism, manufacturing, basic production, and other factors, sectors of the economy? That real sector must be generating output, not just income in forms of nominal incomes. We should be generating real incomes that match the value of the currency that you are increasing in people's hands. So it's a difficult situation, it's a difficult call, but I think the Ministry of Finance and the central bank should be having joint sessions and see how their policies are complemented by each other instead of being contradicting each other in the process. So it's a work that requires a complete synergy between these two institutions to ensure that they're on the same page.
All right, let's look at how businesses will fare in this year. Now, a report released says that Nigeria's Purchasing Managers Index, PMI, increased to 52.7%, but the business outlook for 2024 stands at a decade low. What could be the reason for that? And how can businesses breathe in this year?
Yes, I think the effect on businesses should depend on the type of business we are talking about. We have to differentiate between businesses that render services and businesses that produces need to haves. So if the need to have businesses, when I say need to have, I mean things that people cannot do without, things like food, transportation, things like basic food, transportation, clothing, and others. They are needs to have. Such businesses will still thrive, given the fact that people cannot do without them. And so, irrespective of the level of income, such businesses will not be heavily impacted by rising prices and by sluggish demand. But services, which we call nice to haves, the nice to haves are services that are not that people can do without. And in this category, we have services like education, services like tourism, services like hotels, and services like even health. People may prefer traditional health methods to the orthodox methods because, as we speak now, the price of drugs, for instance, have doubled or quadrupled in some cases. So the business generally, the services and goods and services areas that has to do with needs or needs to have will not suffer seriously. But services that have to do with nice to have wants, things that people can actually do without, because people are going to squeeze their budget from luxuries and squeeze them into essentials. And so in the aggregate, it will cancel out. We do expect that the major singular determinant of whether the economy will do well in 2014 is what happens to general prices. If the general prices remain considerably very high, then the total macroeconomic effect on the economy is a slowdown in output. But if government is able to tame the prices, we expect that businesses will rise gently and can generate that 3.9 to 4.0 growth in GDP, which the federal government has estimated, and it's also supported by the World Economic Outlook forecast. The World Economic Outlook forecast says that Nigeria will grow at about 3.9%. The federal government is working between 3.5 to 4.2%. So there's some consistency in the projections. Overall, the determinant of the success of the federal government policies will be based on how it's able to manage the hydra-headed effect of prices on the economy, because that is the pain point. If we're able to deal with the prices of goods and services, which is currently at at one of the highest in Nigeria's history because of the subsidy removal and because of the many policies of government is trying to liberalize the oil sector, trying to liberalize the foreign exchange sector to try to minimize the differences between the exchange rate in the parallel market and that in the official market. That is why you can see the dollar price is seriously hitting against the naira. So what the government is trying to do is to liberalize that sector to ensure that there's no round tripping within the financial sector. So what the government tries to do in a bid to make Nigeria run according to market rules may be counterproductive, given the fact that we do not have commensurate output to match the market dynamics. So we cannot be liberalizing the financial sector in the economy and then output is sluggish. If output is sluggish, what that means is that prices will just be rising towards the rooftop. Nigerians have low income and currently cannot sustain that prices. And so there will be what we call a bubble, that kind of bubble that will cripple large sections of the population, which is already being impoverished. So whatever government does now is hinged on what it's able to do in the financial sector, exchange rate, and inflation rate.
All right, what's your take on the government's push for a credit economy in this year through the financial system? How will it help? Is it going to have a negative impact as we'll talk about reducing inflation?
If we are trying to do a credit economy, then we must also consider something. How much are Nigerians going to pay in interest for that credit? Okay, when an economy is suffering and sluggish like Nigeria, the credit costs go very high. It's not about making credits available. At what cost? That's the question. With rising inflation, the banks and financial institutions want to ensure that because it actually pays to borrow in a situation that Nigeria finds itself now with rising prices. It pays to borrow, but when you pay back, when you try to pay back, the value you are paying back will be less than the value you borrowed. So financial systems will factor these variables into their loan programs and ensure that they charge higher interest rates to be able to bridge the gap between the real value of money and the nominal value of money. Because the debtors, when they borrow these funds, they will be borrowing at a higher rate and of benefit. But when they are paying, given the inflation rate rising, they are going to be paying less. So creating more credits for the economy will help to boost the real sector. But at what cost? At what cost? That's the question. At what cost to the businesses? Is the federal government able to guarantee lower interest loans? So it's not about the credit itself, it's about guaranteeing low interest loans. That can only be done if the federal government guarantees all loans to small businesses. So there should be a fund, at least in trillions, but I don't see that in the budget. So I don't understand the mechanics of that. If you want to increase credit to the private sector, then I should expect that at least 1 trillion naira should have been budgeted to guarantee debts, credit to the vulnerable sectors of the economy, agriculture and other sectors. But it appears the federal government is not operating that system. They are allowing the market itself to determine the prices of credit. Where is the real sector equivalent of guaranteeing that credit such that people can get these loans at a lower rate? That's the question. I don't see that in the budget. I don't see how government intends to expand credit without dealing with the cost of credit.
Let's focus on the oil and gas sector. You know, that sector is very critical to the economy. The projection for the year 2024 is with the commencement of operation by Dangote refinery, and then the fact that you have Port Harcourt refinery to be back in operation. Now, the projection is that is going to reduce imports and also increase trade surplus. How do you see this playing out, especially now that you have framework for local production of oil? How do you see this playing out in the year 2024, the oil and gas sector?
Yeah, the biggest advantage from that realization is the fact that we are going to save a lot of foreign exchange. That's the only major impact. A lot of people, in the next 3 to 4 years, Nigeria is going to save over $30 billion of foreign exchange, given the fact that we are not patronizing a local manufacturer. So that's good for our foreign exchange management. We will not need dollars to import petroleum products. We sign contracts with Dangote refinery and those local producers, and then because dollar is not exchanging hands in that transaction, we expect that the federal government and Nigeria is able to save a lot in foreign exchange. But beyond that, a lot of people have imagined that it may affect the prices of petroleum products. There's no reason to believe it will affect the price of petroleum products, because the prices of petroleum products are determined internationally. And Dangote is a businessman. We expect that they will try to make profit, and they are going to charge a price that is consistent with the world price. And it may not, the immediate benefit to Nigeria will only be in the foreign exchange angle, but not in the price angle. Before we begin to see impact on prices of petroleum products, we are going to also, it will take about 3 to 4 to 5 years where other manufacturers, other producers come on stream and compete at the market level. Also, that sector is also going to be expanded in 2024, because the output of those refineries will be reflected in the gross domestic product. So we expect our GDP to increase and expand significantly, given that a major player is coming on stream to produce output. So our domestic economy will expand to the extent of the expansion of those refineries. So we expect more jobs to be created directly or indirectly. At the moment, about 16,000 people are already employed in that refinery, in direct and indirect jobs. We expect a multiplier effect to generate more incomes for the economy. That's what we expect to see. It's going to be positive. It will be a positive addition to the Nigerian economy. We do not yet know how it's going to impact on prices, definitely, except that from our collected wisdom, we do believe that the prices will not significantly be impacted, but the exchange rate will significantly feel the benefit of having a local producer producing domestic petrol, and even possibly exporting to other African countries. So it's a plus for the Nigerian economy.